So what is a cap rate? Well, a cap rate is the gold standard that real estate investors use, and it refers to the ways that buildings are evaluated. In simple terms, it's calculated by taking the net operating income, okay, which is known as the NOI, and dividing it by the cost of the building in order to give you a rate of return for the purchase. So the capitalization rate equals the net operating income divided by the cost of the building. And it's a great unifying metric just because it assumes the property is purchased in cash and not a loan, because loans can just vary so widely based on how much you get financing for, whether you get financing at all, and it can really convolute the valuation of a building, right? And it just allows you to compare different buildings really quickly at a glance to determine the asking price and how that's valued based against the rent. So what is net operating income? Well, that is simply your annual rent minus your taxes, your insurance, any other expenses such as maintenance that you might have, to give you kind of like your cash flow before the debt consideration. So to get a cap rate, let's just say that the NOI is $100,000 and the cost of the building is $1 million. Well, 100,000 divided by 1 million is going to equal 10%, right? So that means you have a 10% cap rate. Now, the reason that cap rate is so confusing is because the price of the building goes up, okay? And the asking price goes up as the cap rate goes down. So a lower cap rate equates to a higher priced building. I like to think of cap rate as potential return on investment. And you have a bunch of different cap rates from all the way from 15% to 5%, all right? And why would buyers be willing to get lower returns on their investment? Well, it's because risk, all right? The return is associated with the amount of risk involved in the purchase price of the building, and more specifically in the tenants, okay? Because think about if you've got a mom and pop tenant versus an accredited tenant, okay? Mom and pop tenant, somebody who owns one single hair salon, or maybe it's a gym. If they default on that lease, on the terms of their lease, what are the chances that you're gonna be able to get that money that's owed on the lease? Very, very low, right? Or there's also a higher probability that they will not make it to the end of their lease compared to an accredited tenant, right? Such as a hospital-backed urgent care or a Starbucks. You know that when they sign the lease and the company's behind it, you are going to get that money. And that is why you will be willing to go from a theoretical, 10%, 12% return on your money, like 12% cap rate, all the way down to a 6%, 5% cap rate. Sometimes I've seen them in the high fours. There are a couple flaws when it comes to cap rates, okay? First of all, the debt consideration. Like we talked about earlier, cap rates do not take debt into consideration, and therefore the cap rate is not to be confused with your ROI, and more specifically, even with your cash-on-cash ROI. Those should be calculated separately based on how you are going to manage the debt, or you're going to buy in cash or whatever. And the reason is because the amount can vary widely, and it varies from person to person. So it's just a unifying metric. Now, the other flaw about cap rates is the appreciation, okay? It uses the most recent year's financial reports, financial reporting. And so if the building is going to appreciate, which it will, because either of the rents are going to increase over time, or just because you're confident that the city, the location that it's in, is going to have increased real estate, that's also not taken into consideration. So all in all, it's a great metric. That's why everybody uses it, and I hope this is helpful in teaching you a little bit about cap rates. Obviously, here at Leaders Real Estate, we're more than happy to answer any questions and help you guys if you're looking for a property or just want some more information. Feel free to drop us a line or shoot us an email.